Hello all, welcome to www.bispsolutions.com. In the webinar series Financial Planning Using Excel, today we'll see an essential concept in financial planning, that is forecasting. Forecasting is required not only by financial analyst but also by business analyst, marketing analyst and data analyst. It is the process of estimating future values based on historical data, trends and assumptions. Now, forecasting is widely used in finance, economics, supply chain and business planning to predict revenue, expenses, demand and market trends. So, forecasting involves making educated guesses about future events that could affect a company. Businesses can predict sales, finances, customer demand, and market changes by examining past data, trends, and patterns. You can see in the image provided over here the importance of forecasting in business. Decision making. So, forecasting plays a vital role in helping organizations and individuals make informed decisions. Predicting future events or trends provides valuable insights that guide the decision-making process. This helps businesses and individuals choose the best course of action based on the available information and likely outcomes. Then, with the help of planning, resource allocation can be done, including time, money, and personnel. By predicting future demand or market conditions, businesses can adjust their production levels, staffing requirements, and budgets, ensuring that they are well prepared to meet customer needs and remain competitive. It helps in risk management. So, identifying potential risk and uncertainties is essential for any organization. Forecasting allows businesses to anticipate possible challenges such as economic downturns or fluctuations in customer demand or supply chain disruptions. Then next we have setting goals and targets. So of course, forecasting would help organizations to set realistic goals and targets for their operations. Budgeting and financial planning. Accurate financial forecasts are crucial for budgeting and financial planning. They help businesses estimate revenues, costs, and cash flows, enabling them to create budgets, plan investments, and manage their finances effectively. And lastly is the supply chain management. So in the context of supply chain management, forecasting is essential for maintaining the right balance between supply and demand. Accurate demand forecast would enable businesses to optimize inventory levels and minimize holding costs, ultimately improving customer satisfaction and the efficiency of the supply chain. So the concept of forecasting and its importance I will make you clear by a short story over here. So there's a startup perfume brand which is Scentwave, and it has been selling perfume for past few years. Now they need to forecast sales for the next 6 months to optimize their inventory, to plan the budgets and ensure smooth cash flow. You can see here their sales data for the past 6 months. In the left hand side, the first pic you are seeing, this is their sales data for past 6 months. Now with the help of forecasting, they forecasted sales for next 6 months. There are various tools, methods implement for forecasting. Implementing that, they achieved the figures. Now with the help of these figures, the forecasting impact on the business, it would be that this perfume brand would do the inventory planning. Now, without forecasting, the company might overproduce or run out of stock. Now they know that they need around 30,400 units. If I add this all up from July to December, they would be needing to produce 30,400 units. This will also impact on their market strategy. Like there is peak demand in November and December, you see over here. This suggests increasing advertisements in the month of September and October. Okay, so this will impact the marketing strategy. They can plan discounts for slower months, like here in July and August the sales is less, so they can plan for certain discounts and offers. This will also help them to manage the cash flow. Now, knowing the expected revenue, they can manage supplier payments and they can reinvest in growth. Now, imagine investing millions into opening new stores, only to realize later that customers weren't coming in as expected. This would lead to store closures, job losses, and financial setbacks. This is what exactly happened with the Starbucks in 2008 due to inaccurate forecasting. According to the reports published in business news outlets like the New York Times, Bloomberg, and Forbes, also the Starbucks former CEO Howard Schultz discussed that in the interview and Starbucks annual report. In 2008, the company aggressively expanded, but didn't accurately predict market saturation and customer demand. As a result, sales declined, and Starbucks had to close over 600 stores due to complete poor performance. So after this, it adopted forecasting by analyzing foot traffic, local demographics, and purchasing patterns. Now they use predictive analytics to estimate demand before launching new locations, and which thereby, with the help of forecasting, they would ensure profitability. So it is not just a user story that I'm quoting, there are real time examples for you to emphasize the importance of forecasting. Now, steps in the process of forecasting. It involves a series of steps to make sure that predictions are accurate, and it helps in effective decision making. So first you have to set clear goals. You have to start by deciding what you want to predict and why. So figure out the purpose of the forecast and choose the time frame you are interested in, whether it could be short term, medium term, or long term. Then you have to gather information. You have to collect the past data related to your forecast, like previous sales numbers, market changes, or any economic signs. Next, you have to pick the right forecasting technique. You have to choose right method, which is based on your goals and the available data. There are various methods, including qualitative approaches and quantitative methods, that is, statistical models and algorithms. The fourth step here is you have to choose the method to examine the data and look for patterns, trends, or relationships. Then make the forecast, which is based on your analysis. Make educated guesses about what might happen in the future. You have to keep in mind the limitations of forecasting and the uncertainty of the future while making your predictions. Lastly, you have to validate the forecast, review, and adjust. So you have to check your predictions against actual outcomes or historical data to see how accurate your forecast is. So let me show you how to create a precise forecast in Excel. So we'll quickly go to our worksheet over here, as we are carrying on the same example of a mid-size IT firm, Technowave. And here you can see the historical data for 3 years, and this is quarterly sales. This is the actual data available for every quarter starting from 2022 to 2024. And here we are forecasting sales for next 2 years. So quarterly sales that we are forecasting for next 2 years. So for March, every quarter you can say of 2025 as well as 2026. So that I have already created the format for you so that it saves our time here. Now this is your actual data over here when I talk about this. Okay, historical data that you say. And here, with the help of this data, we're going to forecast sales for next 2 years, quarter sales for next 2 years. So for this we'll use forecast linear function. The first, I've already here provided the heading of this linear function. For this we're going to use forecast linear function. So it will calculate or predict a future value using linear regression. All these over here, when I talk about forecast functions, all these are categorized under Excel statistical functions. There are certain arguments which it is going to pick up to provide you the result. So for the first one over here, we're going to use forecast linear. So this function, this will actually use linear regression for providing the values. If you see, the argument needed is first is x, then known y's and known x's. So x is a numeric x value for which we want to forecast a new y value. Here x would be our March 25. For the month March 25, we want a new y value, that is sales. Known y's. Okay, so let me start with writing the argument over here. So this is your x, that is the numeric x value for which we want to forecast. We are forecasting for March 25, comma, then we have to use here an array or you can say a range of data. This will be known as known ys. So here just select this. And lastly we have known x's. So this is the independent range of data. Over here the date is independent. Select this. Okay, also to scroll down this formula, you have to make this static over here. That ways if you move the formula to other cells, it's going to follow the same approach. For this here, put the dollar sign. This you can also do with your F4 key. This way if you copy it below, it is not going to change the value. So that's it, and enter. And scroll it down. So here this is a linear trend. Okay, this is the forecast figure following the linear regression method. Now let's suppose you want to see this in the form of a chart. Just select this. Pictorial representation is more interactive. So from here you have to go to insert and go to the chart options, and we'll pick the linear chart over here. Okay. So this way you see the chart over here, which is a straight line you can see. Now if you want, this is the forecast data for 3 quarters, for the 4 quarters of the 2 years. Now to check it with the historical data, you can again over here select your historical data, and under charts again we'll take the line chart over here. Now if you compare two charts, this historical data, it is showing fluctuations. The sale is in the month of September. If you find in the third quarter of September, every time there is increase, while if you find here every, like in the first quarter, there is a drop in sales. So this could be due to seasonality, or it could be due to certain market trends. But if you see the linear forecast, it is just showing you that the sale is increasing every quarter, which doesn't depict the actual situation. So here we have used this. The first one, this is the linear trend. So data with a linear trend, but there is no seasonality. So if there is a linear increase or decrease, this function is sufficient. But in case your data, your sales over here has fluctuations, that is, it decreases with seasons, or it decreases or increases with certain trends, then you have to use another function that I'm going to do. It will delete these charts over here for the time being. So here we're going to find the seasonal forecast with the help of another forecast function. So we're going to use forecast ETS. And now this will this function, basically this uses exponential triple smoothing ETS to account for trends and seasonal patterns. It can detect and adjust for periodic fluctuations. It is a more advanced prediction method. So it works better when data has non-linear trend, or you can say repeating patterns. So whenever you have a data that has seasonal variations, like monthly sales that peak during the holiday seasons, you can use forecast ETS. So to use it, you have target date, value, and timeline. The other here the other points which you have, arguments, it is in bracket, so this is not required, it is optional. So if you have the data for seasonality, data completion, aggregation, you may provide it. Rest first three are the important ones. So first you have to select your target date. You're calculating it for March 25. Select the first value, that would be the range of value over here, and the timeline range. And don't forget to provide the dollar sign over here, which you can do with your F4 key. And drill it down. This way you get the seasonal forecast. Now let's use this to create the chart, so that we are going to see the linear forecast as well as seasonal forecast. So I'm choosing the entire area over here for the chart, and again we'll use the line chart over here. So this way you can see the change in the trend. Unlike linear, the first one, the blue one, is linear, you can see here. Unlike linear, the seasonal forecast, this is more advanced prediction. You can see that the fluctuations it is showing, which is similar to the historical data. Now let's remove this chart. Now if you want to see the seasonality or the recurring pattern of this, that is how often that this arises, the sale, okay, the seasonal or the linear, for any of these you want to see, you have to understand if you want to understand the cyclic trends, is it like monthly or this forecast, this is for quarterly or yearly. So for this we're going to use another function here, and that would be ETS seasonality. Again here you have to provide this value over here, which would be your sales, the historical actual sales you can say, and you have to choose the date, which is the timeline range. Data completion, aggregation, they are given in the square brackets, so they are optional. If you have that data, you can provide. Obviously it is showing 4 because we are doing it for quarter. If we would have been doing it for monthly, it would have been showing here 0 or maybe 12. So see, everywhere here the trend over here it is 4. So this is basically to understand the cyclic trends in data for more accurate forecasting by setting the seasonality parameter. So if your result it is 0, then there is no seasonality. So the data follows a simple trend. If there's any number, like here you find it 4, which is greater, if it provides you any number which is greater than 0, it indicates a seasonal pattern length. Like if you have monthly data with a yearly cycle, then here it would provide you 12. Like here, if here it is showing you 4, it suggests a quarterly pattern. So if you want to see the pattern of this forecast, you can use seasonality. Now you have forecasted these figures. This is linear forecast. It is showing linear trend, that is every time the sale is increasing. To be more precise, you have provided here seasonal forecast, that is, it will provide you the variations of fluctuations, which is more accurate as compared to linear. If your data has certain drops and it has peaks and drops. Now if you are not even after that, if you're not that much confident about this data, you can use here another function for the confidence level to check the confidence of this forecast. So here we're going to use another function. We're going to use ETS confined. Now this will calculate the confidence interval for a forecasted value which is generated by forecast ETS confined function. Okay, now this is over here your with this you have done the seasonal. So this same, if you want to see the accuracy of this figure, then you can use this confined. So it helps assess the reliability of the forecast by providing an upper and lower range. Let's see how do we do this. You have to select the target date, which is here March 25. Then next you have to select the value and the timeline, so which is still the same. We have the value here as the entire historical sales, and the timeline is the date range that we have provided. Okay, now it is asking over here confidence level. So how accurate you want it to be. Let's suppose here we can provide let's say 95% accuracy if you are looking for. And rest seasonality, again the other arguments, it's if you do not have that, it's okay, you need not provide, and if you have that data also, you can provide it. So here we are checking this accuracy by 95%. I have given the confidence level here, you can see. And okay, there's some error in the formula, let me check. Okay, this is actually at C only. Now just scroll this down to have the accuracy figure for the entire data here, entire seasonal data that we have calculated. Now this is actually providing you the range. With the help of this range, you will get upper bound and lower boundary for your sales figure. So your seasonal forecast plus your range that it is providing you, confidence level it is providing you, if you add this both of them, you will get the upper boundary for your forecast. Similarly here, if you deduct the range from your seasonal, you will get your lower boundary. Now, so this makes sense for the 95% accuracy. This range has been provided over here. You have calculated this at 95% over here. You can see 95% accuracy. And over here, when you get this range, once you add it to your seasonal, you get the upper level of this revenue forecast, and you get this. So it means at 95% accuracy, your sale would be lower by this range, or if you find this one, so this forecast, this is your upper level, your sales would be as high as this at 95%. Let's change the accuracy level here and see what happens when I change this to 99%. That is, we want the high level of accuracy, the highest level you can see, and just drill it down. Now you see this at the 99% range, this becomes higher. So it is but obvious, if you want to have more accurate, the sale level over here, the sale forecast seasonal, this would be giving you a higher range. Okay, and if I'm looking for lower range, so I can here select 90%. So at 90%, you can see this is lower down. This way we can forecast there are different methods available. All these are known as conditional Excel statistical functions, which help you to forecast different, like here you have forecast linear trend, then you forecast with the fluctuation seasonal, and you have shown you with the help of chart how it is different. So but still the functions are there, formulas are there, but still if you want to simplify it further, you just have to go to your forecast sheet, and before that just select the data you want, and under this go to data, and there is a forecast sheet available which will create all these linear forecast, seasonal forecast, upper level, lower level boundaries. So I'll click over here. See, now over here the blue line, this blue line chart, this shows you the historical sales, which we have derived from this we have already provided. Then over here the orange middle line, which is the bold one, this is your forecasted sales. Over here these two, the orange graphs, the first one, this is your upper boundary and this is your lower boundary. So everything in the forecast sheet, everything is provided. Even you can make certain changes, from here options. So if you see under options, there are forecast end. You can over here you can provide, you can change the date. Here the forecast ending date here is December 26. If you want to carry it further to December 27, you can increase the date from here. Start date also you can change. Even confidence interval, this is at 95%, you can increase the interval percentage over here. So you can make the changes accordingly and you will have this graph changed. And once you finish this, the screen has got stuck somewhere. Let me try it again. So once you click on create over here, you can select the options that I have shown you. You will find your, let me minimize it so that both the data and the graph comes together. This way you have your data over here from this A and B. This is your historical data that we have provided. This is your forecast. Here you have the upper confidence boundary and here you have the lower confidence boundary. So this is all about forecasting. Hope you have understood it. But still, if you have any queries, you can contact